Hello, everyone. Thank you for joining us today. I'd like to welcome you to today's session, Accelerate Your Month-End Close, a Controller's Guide to Actionable Financial Reports. So, my name is Courtney Pollock. I am coming to you from North Carolina today, and I will be the host from SWK. Before we dive in, I have just a few housekeeping items to go through. And, as I said in the chat, we'd love to hear where you're joining us from. We'd love to hear from you throughout. So with that said, today's session is being recorded. We're going to send out the recording to everyone who was able to attend today and also those who registered but were unable to attend. And we'll send that recording out to you tomorrow afternoon. So just keep an eye out. It'll come to you from SWK Webinars. And then also everyone has been placed on mute to keep the background noise to a minimum. However, we highly encourage you to ask questions in the Q&A panel, to chat. We'd love to hear from you, and to also participate in the poll that we'll be running at the end of the session. So you can do all of that on the right-hand side of your screen, and you also have some different controls to use as well. So that pretty much covers our housekeeping items for today's session. As always, we're thrilled that you've taken some time out of your busy day to be with us on this session. SWK is always here to help you fulfill your vision of a smarter and easier way to run your business by providing you with tools, support, software, and industry knowledge whenever you need it. So check us out on our social media channels, Facebook, Twitter/X, LinkedIn, YouTube, all of those places. You can find us there. We'll share more content. You can catch up on our other upcoming webinars, past sessions, etc. We really want to be there for you and help you find important information. So that is going to be enough for me right now. I'm actually going to hand it over to today's presenter, Jake Morris, and bring him on stage so we can get to the main event. So Jake, let me bring you on here. Hi there. I'm going to hand it off to you.
Sounds great. Courtney, thank you for the introduction. Hello, everybody. Nice to meet y'all. As Courtney mentioned, my name's Jake Morris. I'm a partner at a CPA firm called Whitley Penn. I'm based in Houston, Texas, but a little quick overview about our firm. We are a top 35 CPA firm offering audit, tax, and consulting and advisory services, based out of Fort Worth, Texas, and have offices kind of all over the state. So offices in all the major metropolitan areas in Texas, and have one tiny office in Hobbs, New Mexico. So although we're a regional firm with offices all really just in Texas, we have our client base all over the United States. I see a lot of locations kind of from coast to coast, so it's good to have a wide geographic pull on the audience here. And I'm really excited to tell you all about this. Background for myself, I've been at Whitley Penn for 5 years. And like I said, a partner in a group that we call Client Accounting and Advisory Services. We just refer to it as CAS for short. Previously in my career out of college, I did corporate audit at another accounting firm for 6 years, auditing public and private companies, financial statement audits, as well as internal control audits. And after that, I moved into an industry position and was the controller and de facto CFO of a law firm for 4 years before getting the itch to come back to public accounting and join Whitley Penn in March of 2020. So if anybody's familiar with something that might have happened in March of 2020, I did start right at the beginning of the COVID pandemic and spent the next 2 months afraid that I was going to get let go. But here I am. Not sure if they forgot about me during that time period or what, but the rest is history. So appreciate y'all joining us. Excited to tell you about this, as I think I have a pretty good background in this area, coming from the audit side, the industry side, and then now on the accounting advisory side. And what my group does at Whitley Penn is we assist clients with all types of outsourced accounting up through controller and CFO services. So lots of small to mid-sized businesses that either have a small accounting department or no accounting department at all can outsource their accounting services to us. We'll take all of it from accounts payable, payroll, invoicing, monthly reconciliations, obviously the monthly close work that we're going to talk about here, financial statements, any kind of management or board reporting. So we can do all of it, or we can do a piece of it if clients have certain folks in their accounting departments and just want to outsource one specific function or a handful of functions and keep a couple of those in-house. We also do a lot of controller and CFO services for larger clients that might want those as a fractional basis. So fractional meaning maybe we don't want a full-time controller or CFO. We're a growing company, have some needs in that area, but don't have needs for 40 hours a week, right? So we don't want to pay somebody a full-time salary. So they will hire us as a fractional, and we can do that for 10 hours a week, 20 hours a week, maybe 10 or 20 hours a month if it's a little bit lighter. Up through, we can do it on an interim basis as a kind of full-time interim. If a company has lost a controller or lost a CFO, we can come in and sit in that chair, learn the responsibilities, fill that gap until they do bring in a full-time hire back, and then we'll obviously train the new person that they hire back in. So obviously have kind of a wide breadth of experience in accounting and finance departments. We work a lot with companies kind of from pre-revenue, no revenue, up through about $100 million in revenue. That's kind of our sweet spot. The outsourced accounting side tends to be 0 to about 40 or 50 million in revenue, just tend to be a little bit smaller companies that have a little bit leaner structure, leaner teams, and that outsourcing model really makes sense for them. The controller and CFO services tend to be a little bit larger clients, and then certainly the clients that we assist on an interim basis as a controller or CFO that have full-time needs in that area, those are larger and kind of go up north of 100 million and have touched clients as big as about 800 million in revenue. So know all the kind of different size companies across the board, kind of 800 million and under, and know all the needs and pain points that all the different accounting departments are facing. So let's get into it. Just to kind of level set, I'm sure most of us on this call know what month-end close is, but to make sure we're speaking of the same things and referring to kind of the same procedures, what is month-end close? Month-end close is the finalization of your prior period accounting. This includes performing reconciliations on all your rbalance sheet accounts, right? We're reconciling cash, we're reconciling credit cards, we're reconciling our payable subledger, receivable subledger if we're big enough to have defined subledgers. A lot of times month-end close includes adjusting journal entries. So certain things that we might have to book to get into the previous month. So right now we're March 19th. If we're talking about closing the month of February, maybe there are some transactions that did not hit the month of February through the cash side. So we would need to perform adjusting journal entries to get those transactions into the month of February. Maybe it's accruals for certain expenses, invoices that we issued in March that we want included in February if the services were performed in February, getting all the books tightened down with those adjusting journal entries, and then preparation of the financial statements, so balance sheet, income statement or profit and loss, and then a statement of cash flows, any additional financial statements or management reports that go along with that. And then lastly, reviewing those financial statements. You know, typically the financial statements get prepared, then they get reviewed by whether it's a controller or a CFO, upper management, a board of directors, kind of whatever that chain of review is, gets reviewed, made sure everything is good, and then we, you know, perform our final reporting on those financial statements and then close the month officially. There are a couple different bases of accounting that people handle their accounts on. Cash basis, which is very similar to tax basis. That's just handling your accounting as cash goes in the door or as cash goes in or comes out. So pretty straightforward, does not usually involve any month-end adjusting journal entries because the accounting is done based on the cash activity for the month. So there's not a lot of additional work to be done beyond coding your transactions, reconciling cash, reconciling your credit card accounts, as everything is typically captured there. Usually as companies get a little bit bigger, they might have different reporting demands. You might have different parties that are interested in your monthly financial statements or management that wants to see things on an accrual basis. So accrual basis is recording transactions when they're earned or incurred. So not necessarily when the cash comes in or goes out the door, but when the services or the goods were either sold or purchased. So this includes accounts receivable, accounts payable. You know, if you have a cash basis set of financial statements, you're not going to have AR or AP. If you have accrual basis financial statements, you will have AR or AP. So if you're issuing invoices to clients, you're going to have an accounts receivable line as you're processing your payables. at the end of the month, when you close the month, you're going to have an accounts payable balance for all of those payables and invoices that are, figuratively speaking, sitting on somebody's desk waiting to be paid, that we received in the month of February, for example, but have not paid yet. So that's going to be sitting as accounts payable. And in order to really close out the books on accrual basis, it includes adjusting journal entries to tie out your revenue and expenses to that proper period. As I was mentioning earlier, if we perform any invoicing in March for services that we performed in February, technically, to get those books closed accurately, we would want to include those invoices in the month of February because that's when we perform those services. Additionally, for any expenses that we receive invoices in March, or we know we purchased things in February, or we have not received any invoice yet, we want to accrue for those, perform adjusting entries so those expenses hit the books in February. And then another couple of items that typically have accrual entries are prepaid expenses. So that would be if we pay a software license, right? Those are a pretty common one, or insurance. If we pay something that's a 1, 2, 3 year license or covers an extended period of time, typically on accrual basis, we're going to capitalize that and amortize that over the period to which that expense covers. So if we have prepaid insurance and it is a 12-month insurance policy, a lot of times, right, we'll make our insurance payment for the full policy, but it covers 12 months. So we would capitalize that as a prepaid insurance asset, and then every month end closed, we amortize or expense 1/12 of that prepaid insurance. So for example, if it was $120,000, we capitalize that. The following month, we'll want to amortize and expense 1/12 of that. So we would take $10,000 and perform an adjusting journal entry to expense that. So that hits the income statement or P&L in that specific month to which it relates. And then lastly, we have GAAP basis. That stands for Generally Accepted Accounting Principles. Usually as companies are growing and you start getting external investors, if you're talking to banks or have any significant debt, a lot of times bank will require your financial statements to be done on a GAAP basis. If you are a public company or thinking about becoming a public company, you certainly have to have GAAP audit. So this is a specific set of accounting standards based off of accrual basis. It's accrual basis of accounting, but also has some additional reporting requirements that are quote unquote GAAP required. And some of those being like lease accounting. If you have an operating lease, if you have a 10-year office lease, which, you know, a lot of times corporate office leases can have really long lease terms. So traditionally, I'm just going to expense it as the lease payments come in. But GAAP now requires you to take that entire 10-year lease, fair value it, and then book it to your balance sheet as an asset and a liability. So the entire lease hits your balance sheet. So a couple other nuances like that are under GAAP basis if you do have those reporting obligations. Obviously, the procedures around your month end close depend on the basis of accounting that you're having to account within. Benefits of a month end close. You know, I'm an accountant. I've been spending my entire career kind of in this space, whether it was on the audit side, auditing companies' annual numbers, whether it was as a controller, closing the books internally for a company, and then now as a consultant and an advisor assisting clients with their accounting. You know, I'm a big proponent of a very tight month-end close. I think it's really valuable and certainly important from a financial reporting, governance, and kind of oversight of a company. I know depending on the life cycle that companies are in, they might be kind of at a different phase and different level of month-end close. But you know, I really think having a dedicated and diligent month-end close obviously improves your financial accuracy, right? We're saying, hey, right now, if we're closing February, we're going to spend time to get those books closed for that month. And then once we get it done, nothing changes. So we know what our February results are. A lot of times companies that don't have that dedicated month-end close will go kind of back and forth. And maybe in the month of April, we receive a bill that was dated in February. So we go back into February and add that bill. I know that's kind of human nature of, oh, I need to get this back into February to which it relates. But now the numbers that you thought you had in February are going to change. So we're constantly going into this back and forth of changing things in prior months. And then you really have no good idea of what your results were for February. Obviously, that helps with decision making. Having an idea of your real time sales and expense tracking, any companies that are doing annual budgets. If we have a 2025 budget, I want to track my actual against that budget to see how we're doing. I want to know what kind of decisions I need to make to accomplish some things. And if we're over budget in certain expense areas, I want to know that because I want to tighten my belt on some things. Or if we're under budget in certain expense areas, then hey, maybe there's a little bit more room to spend some more money and hopefully get a return on some additional investment in areas. So obviously having that tightened monthly close can assist in better decision making because you have good visibility into what the numbers are. And then, as you get bigger, depending on kind of the size, there's a lot of obligations that come at it from a regulatory standpoint. Like I said, if you have external investors or if you have bank debt that's of a significant amount that the bank wants either monthly or quarterly financial statements, you need to have a tight monthly close and generate financial statements that are not going to change in the future. So when we close the month, those financial statements need to be what they are going to stay. Additionally, with debt, you'll have financial covenants that we need to track against, right? There are certain ratios that banks want to see to make sure your financial health stays at the level that they want it to as they've underwritten your debt, right? If they're lending you money based on your financial health now, and there are some things in the future that change and negatively affect your financial health, the bank is concerned about that, right? Because that can affect your ability to pay down that debt that they have with you. So a lot of times they will add financial covenants and check your ratios in certain areas. So having a dedicated monthly close will let you see how you're doing and how you're performing in regards to those covenants, because the worst thing we want to do is bust a covenant, have to talk to our banker, have our bank upset that we've blown a specific covenant, and then technically a lot of loan documents say they can call your debt if you bust a covenant. So really want to have good oversight as we're tracking towards those covenants and against those covenants. And then next one would be detecting fraud and mitigating any kind of risks that come up. Just having better control and visibility into your monthly numbers will keep you on top of any expense accounts that are going really out of whack, or the more involved in your monthly results and your monthly reports, the quicker we'll notice an area that might be completely out of whack. If an expense account is much higher than you expected, then maybe we ask a question about it or poke into it a little bit, and maybe something nefarious was going on behind the scenes. But you're really never going to know that until you start paying attention to your numbers on a monthly basis and have that monthly close. And then for clients to say, yeah, I'm not quite big enough. None of this stuff really matters to me. I don't have debt, or I don't have any specific covenants or compliance obligations. Cash is king for small businesses, right? And so I talk to a lot of business owners still that they just say, hey, as long as my cash balance is growing, like I kind of have a good idea on our sales numbers, and as long as cash is growing, I'm good with it. But my counterpoint to that would be, if really your main concern is cash, if you started doing a monthly close and generating monthly financial statements, you can track your cash flow on an even tighter basis, right? You can do what's called a 13-week cash flow, which is something that we perform often for our clients. And that's essentially tracking and forecasting your cash out for 3 months, 13 weeks being kind of the 3-month period, pretty standard deliverable kind of in the forecasting and FP&A world. So you can take your actuals as of the end of the previous month and then forecast that out 13 weeks. So you have a good idea of where you're tracking and forecasting from a cash flow standpoint, and then can measure up against that as those weeks come across. So you'll really have a little bit better idea of the health and how you're going against that forecast. And then if you don't care about any of that, and all you care about is getting your taxes prepared at the end of the year, maybe you're doing really well selling your services or your widgets, and cash is good, so we don't care about any of that stuff. You still have to get your taxes done, right? And so at the very least, staying on top of your financial statements on a monthly basis, even maybe a quarterly basis, can greatly assist with year-end closing, getting all those documents to your tax CPA. I work really closely with our tax department here at Whitley Penn, and hear about a lot of their clients that when it comes time to get that PBC list or prepared by client list from your tax CPA, that can be a pretty painful process for a lot of their clients, just because they have 12 months of having to get their books closed and get all their support behind the numbers and receipts and everything like that. So the more on top of it you stay on a monthly basis, the smoother it's going to be at the end of the year to get all that prepared and delivered over to the tax folks. So now we've talked about the importance of a monthly close. I've gone on my soapbox about why I think it's important. And now let's talk about ways that we can speed up monthly close. So I have 5 specific ways to talk about speeding up monthly close, and then I will go into each of them in a bit more detail on the following slide. So the 5 ways to speed it up would be: 1, to define and standardize your procedures and your timelines around that monthly close. 2, automate repetitive tasks. 3, use real-time data. 4, reconcile your accounts more frequently or implement continuous close. I'll explain that a little bit coming up. And then 5 would be to use estimates if needed. I'll expand on that again as well. But like I talked about previously, we don't want to keep the books open waiting for specific invoices if we're not going to get them for 2, 3, 4 weeks after the end of the month. Once we do that, if we have an idea of what those invoices are, it's okay to use an estimate to get the books closed so we can report on a previous period and then move on. We'll talk about how to do that coming up. So first one, define and standardize procedures and timelines. So, when we're working with clients, we like to advise on really starting with the final reporting date first. When do you need your financial statements done to deliver either to a board of directors, if there's a board meeting, to management, if there's a review by management, business owners, any external investors, anything like that, the users of the financial statements, when do they need the financial statements? Whether it's the 10th, the 15th, the 20th, whatever time period they need it, usually recommend starting there and then kind of backing into that date. So once you have the date that everything needs to be done by, we can create a schedule to achieve that deadline. We're talking about looking at all the tasks that you need to close the books and then assigning responsibilities depending on how big your accounting department is, right? Maybe this is one person or 1 or 2 people handling a lot of it, or maybe you have 10 or 15 people in your accounting department. So once we have the date, then my recommendation is to figure out all the procedures needed to accomplish a close of your books, right? Getting cash reconciled, getting all your credit card and other balance sheet accounts reconciled, any of the adjusting journal entries that we were talking about. Who needs to do those? Who's involved with reviewing those? At what day do those need to be done? So any additional procedures can come off of that. There's something called a closed checklist for any of y'all that do not know what that is. It's basically a checklist that has all of your closing procedures on it, right? So after we've figured out the reporting date, we've figured out every task needed to accomplish our close, we'll create a checklist of all of those. And then in addition to the procedures needed to get the books closed, we will have a responsible party for each procedure and the date that that needs to be done by. And then a lot of times we'll have a reviewing party. So that's used at the end of every month. It gives better tracking and visibility into how close is going, right? If I'm the CFO and I have a team of 15 people, if my reporting is due by the 10th of the month, every day before the 10th of the month, I'm going to check in on that closing checklist and see how we're going, right? We're going to have things that are due by day 2, day 3, day 4, day 5 to make sure people are staying on top of their things. And it will provide, oversight into the people that want to make sure we're tracking it correctly and properly. And then it will provide accountability to the people that need to be performing the responsibilities. And then, making sure that if anybody has review responsibilities, they see when things are prepared and they sign off as the reviewer as well. And, the timeline on a close to me is really important. So, how you did in the previous month, like I mentioned earlier. And the sooner you get those reports done, the sooner you're going to be able to make any changes needed to affect all those future months, right? If we don't get our close done until the 25th or, by the end of the next month, well, what if our expenses are way out of line or something that we noticed in those reports gives us an action item to make things better in the future, if we don't know that until the 25th or the end of the next month, we've already lost an entire month of being able to affect any of that change, right? So I always say the sooner you can get your books closed, the better. That gives you more time to address any issues that next month. We try to have them done anywhere between kind of the 10th, the 15th, or the 20th, like I put up there. Typically kind of standard times, depending on team size, obviously depending on needs, the users of the financial statements and everything. But just think about it. The sooner that you get them done, the sooner you're going to have time to make any needed changes going forward. So next one would be to automate repetitive tasks, right? We're talking about doing things sooner. We're talking about getting those financial statements done quicker. One of the easier ways to do that is to use your accounting system to its fullest. If you're in QuickBooks Online or Acumatica or Sage Intacct or any accounting systems like that are cloud-based systems, they're almost always going to automate with your bank accounts, with your credit card accounts. Get those transactions pulled in automatically so there is not any time needed to be spent on grabbing your transactions at the end of the month and then adding them into the accounting system. We see it all the time when we pick up new clients that, okay, it's March 10th, and now I have to go into the bank. I have to download all of our transactions from February. Then I have to manipulate them a little bit in Excel. Then I have to upload them into our accounting system. Well, that takes a lot of time before you can even start thinking about reconciling it or have any idea how you were doing throughout the month of February or where you're at kind of the beginning of March once February has concluded. Well, if you link your bank accounts, link your credit card accounts, any sales, if you use Stripe or any other kind of platforms, the more that you can link to your accounting system, the quicker that data obviously is going to get included in there, which I'll talk about kind of on the next one. But it also allows you to automate any of those repetitive tasks of like downloading transactions and adding it in there. Another thing that could be easily automated would be any recurring journal entries that you're doing. You can create templates of those journal entries. If it is the same journal entry for the same dollar amount every month, almost every accounting system has a way to book that as a recurring journal entry so you don't have to do it monthly. Your task at the end of the month would just be reviewing the entry, making sure nothing changed. Okay, good. It was already in there. Sign off, move on, right? If you have an entry that is the dollar amounts change, but all the accounts are the same, you can create templates. So we just grab our template, update the dollar amounts, and then save that, and then we move on instead of having to hard key and manually add all these journal entries at the end of the month. And then, kind of like I alluded to, if you have any other software components that you need for monthly close, if you have an inventory management software or a fixed asset software that tracks your fixed assets, reports on depreciation, if you have a deferred revenue software, any other kind of external softwares that you can use will help automate any additional things needed to close the books, right? Just take anything out of manual Excel repetition. And, I'm a big proponent of leveraging software. So a lot of the accounting systems will do a lot of this for you within their system and certainly help create efficiencies and speed things up. But if you need to go with an external software, there's a lot of those out there also that can help speed certain things up at the end of the month. And then kind of dovetailing off of that would be making sure you use real-time data. I talked about automating or syncing your bank feeds. So any additional software that you use might have the ability to sync up with your accounting system, and then that would make month-end close so much faster. I gave the example of pulling your transactions off of out of your bank statements and uploading them. So bank feeds or any kind of links automatically populates those transactions in your accounting system. But there are avenues for that for almost any kind of software: inventory, fixed assets, deferred revenue. Almost all external payroll systems will sync up with most accounting systems. So the more syncs, the more links between your technology platforms you have, the more real time that data is going to be. So when February is over and we're thinking about closing the month, all the data is already there. So we don't have to go grab data from here. We don't have to go grab data from here. We don't have to grab it from our payroll software, rework it in Excel, manipulate it, and then upload it. The data is already there. And our job just becomes reconciling it and going with those kind of traditional month-end close procedures. In the accounting world, kind of in this job, I learned what API is for anybody that doesn't know, and y'all feel free to correct me if I'm wrong. I think it's accounting process information, something like that. But it's a big fancy word that really means two technology platforms linking together to share data across the two. So if you have any kind of external operational software or anything, check in to see if there's an API link to your accounting system that you can integrate the two and would make for much more real-time data in your accounting system. So the next one would be to reconcile your accounts more frequently or use something called a continuous close. If you have enough capacity and have enough personnel in the department to do something like this, it can certainly make the close period much quicker. If you have a need for financial statements on the 5th of the month or the 7th of the month, that's going to be a really time-consuming couple of days to get all of your close accomplished within maybe 3 or 4 days to get those financial statements done by that time period. But one way to speed that up would be to reconcile your accounts throughout the month. Instead of waiting until February is closed to start reconciling it, you can reconcile things weekly, right? Make sure all of our cash transactions are in there. Reconcile that with your bank every Friday. So then when it comes to the end of the month, you're not having to reconcile an entire month, and you're not having to look into transactions that happened at the beginning of February if there were any reconciliation discrepancies. Trying to solve for a discrepancy from 30 days ago is a lot harder than if you're doing that weekly and you'll really only have 5 or 6 days to try to solve or look into any reconciliation discrepancies. So can stay on top of it, can make your month end close a lot quicker if we're staying on top of reconciling some of those accounts. And continuous close is just kind of the accounting industry term for doing that on a daily or weekly basis, right? We're reconciling things on a daily or weekly basis, so we have much more real-time visibility into accurate numbers, right? If there's a need to look at my balance sheet profit and loss throughout the month, if I've not closed, if I've not reconciled things, then those financial statements bear a risk of being really wrong. But if you do need that on a kind of more frequent basis than at the end of the month, or if you need them very quickly after the end of the month, think about doing some kind of weekly or daily reconciliation to get those books closed, get those financial statements accurate on a more frequent basis. And then kind of like I mentioned, if month end is becoming an issue with the extra capacity to close, say everybody has their normal full-time accounting responsibilities, whether it's AP or being account manager, or the responsibilities of a controller or CFO. So trying to fit all of these additional close procedures in the first week or two of the month is becoming difficult. If you do a weekly or sometimes daily close, it becomes a much smaller bite at the apple, a bit more frequently, but can kind of streamline that to where it's balanced over the entire month, instead of like 1 or 2 weeks at the beginning of the month requiring a lot more time. Okay, so the last one, mentioned this a little bit. Don't be scared to use estimates to get the books closed. A lot of the kind of smaller business clients that we work with, probably the biggest reason why books are held open if they are doing a monthly close is, well, I don't get an invoice from this vendor until the 20th or the 25th of the month, but it relates to the previous month. And oftentimes it's a vendor they get every month. So, we always recommend, if you have an idea into what those expenses are going to be and you need your close done sooner, or you want to achieve a quicker close, use an estimate for what those expenses are. You can accrue for certain expenses, get the books closed, and move on to reporting on your financial statements. And then when you get that invoice 2 or 3 weeks down the road, you just reconcile it and you net out the difference in the subsequent period, right? So my disclaimer is, don't close February with an estimate, report on it, get the invoice in late March, and then open February back up, change it to what the invoice was, and then re-report on it. Don't do that. If we're wanting to close and use an estimate, then use the estimate, close February, report on it. When we get the invoice in March, maybe we estimated it was a $100,000 invoice and we got the invoice in late March, it was 105. Well, just book that difference into March. You don't need to go back into February to do that. You can just book that difference into March estimate the March one, move on, then you're moving into April. And then what you'll find is as you start doing this, you'll learn procedures to really tighten down on those estimates that you need. If you're working with professional service providers, like us at Whitley Penn, we just issued our invoices around March 15th for the services that we performed in February. So any of our clients that do an accrual or GAAP basis like monthly close, we let them know at the end of February or in early March what we call it WIP, right? Work in progress, what our time is for that period that will be billed later so they can accrue for it and estimate it and get it on the books. So there are avenues that you can, talk to your vendors, talk to your service providers to figure out the amount so we can get those estimated, accrued on the books and closed and moved on. So, just another way to try to speed some of this stuff up. So just, I don't know if anybody on this call has heard of ChatGPT. I assume it's a joke. I assume everybody has now because it seems like it's all over the place now. My kids are learning about it and starting to figure out how they can use it for homework at school. So we're having to kind of run the traps there a little bit. But just wanted to do a little bit of a thought experiment and ask ChatGPT what common reasons month-end close is traditionally late. So we have 7 here, and we'll kind of talk about those and see how we address them in what we talked about before. So this is not Manuel, the name. This is manual. It looks like there's a typo there. Sorry about that. So manual and inefficient processes, which we talked about standardizing the processes. We talked about using technology, leveraging bank feeds to get that done more efficiently. Data delays from other departments. If we go through the motions of setting a closing checklist, then other departments are included in that, right? If I need to achieve or accomplish a close by the 15th of the month, maybe from the procurement or the inventory department, I need your numbers by the 8th of the month. Make sure they're involved with that and know that. But if we have a closing checklist and we have standardized our procedures around that month-end close, then they're going to be involved with it and hopefully help kind of abide by their timelines as well. Lack of standardized procedures, again, talking about that. As long as you set really good procedures, set really good timelines, and work with everybody, that closing checklist helps accomplish this a lot because everybody knows what they're responsible for. If there's any confusion around the procedures, drafting that closing checklist and having everybody's involvement in creating something like that hopefully can mitigate any confusion or issues with the procedures or people's responsibilities around the close. Reconciliation challenges, we talked about potentially reconciling more frequently, weekly or daily. If, like I'd mentioned, if I'm reconciling February on March 15th and there's a discrepancy from February 3rd, that's a month and a half ago. I don't remember what happened yesterday most of the days. So trying to figure out what happened a month and a half ago can sometimes be really difficult and take a lot more time than if you're doing it on a weekly basis or even a daily basis because you're staying on top of things. So if there's a discrepancy, maybe it was 2 or 3 days ago, maybe it was yesterday, very easy to resolve, fix, and move forward. System limitations or integration issues. A lot of people are still keeping their data really siloed. Maybe we have an inventory management system here. We have fixed asset software over here. We have an operational software that handles our sales and invoicing. And then we have our accounting system with our general ledger, and none of them talk. So we have to pull data out of all of them. We have to manipulate the data to get it into our accounting system. Really inefficient. So we talked about linking as many of those systems as we can, looking for any API connections between your external software systems and the accounting system that you use. Late adjustments or corrections was kind of when we were talking about using estimates. If we are closing a period and it is off by a little amount, I'm a former auditor, so the word materiality is important to me, which means there's a dollar amount that if there's something off by less than that specific dollar amount, I don't care. Like, I'd rather things be closed, reconciled, reported on, and then we move forward in a much more timely manner and we fix it in the subsequent month. Obviously, when you're closing your year, we want a much tighter close. Certainly any dollar amount matters from a tax prep side, right? But in interim period reporting, which is kind of monthly, If something's off by a minimal dollar amount, and minimal is obviously a relative term, that's different depending on the company size and kind of what you're paying attention to, but it's okay if it's kind of a minimal error or an estimate that we want to use and can correct it in a subsequent period. And then staffing constraints, I know that's obviously an issue, but the more buy-in we get into the monthly close, the more we include people into setting up a closing timeline, a closing checklist, our closing procedures. I think that helps mitigate some of those constraints because we will come together as a team, figure out what makes sense, what is an appropriate timeline, and how we can accomplish that monthly close in hopefully that faster time period that we're looking for. That's all I had. I hope a lot of that made sense to you all. I hope there were some nuggets that each of you can take and potentially implement in your company. Like I said at the beginning of the call, I've grown up in this world, so majored in accounting, been in accounting my whole career. So certainly see the benefits of financial reporting, how it can benefit business owners, management teams, and hopefully all of you all on the call, and knowing that really having faster results, having better, more accurate results can help you all in strategy and achieving all of the business goals that you all have.
Awesome. Thank you, Jake. So with that said, we are going to open up for Q&A for just a few minutes. I know we're a bit past time, so thank you to all of you that are sticking around with us. We'd love to answer your questions. And then also in the meantime, we're just going to launch a quick poll that will be up for the rest of the webinar. And that's just curious to know how we can help you with follow-up. If there's anything, if we can connect you with Jake, if we can connect you with Whitley Penn, anything like that, or, you're just looking for that recording so you can share this with your team, reference it later, etc. So Jake, we've had some good questions come throughout. So I'm going to dive into those questions, and everyone, just a reminder, that poll is currently live on the right side of your screen. Ready to go, Jake?
I'm ready. Let's roll.
Awesome. So the first question we had come in was, this person says, we're a lean accounting team with very little additional capacity. How can we achieve an accelerated close?
Yeah, so one of the things that we obviously do and try to sell to folks is this is a service that we provide. We have lots of clients that have lean teams, and we really just assist them with closing the books on a monthly basis, because we're going to hire to handle our traditional weekly responsibilities within the accounting department, whether it's accounts payable, whether it is payroll, invoicing our customers, anything like that, right? We're going to staff up to support those needs. So then monthly close sometimes can be a big capacity issue if we're a pretty lean team. So, we like to offer services. There are lots of service providers that do something very similar to us. So think about outsourcing. Like I mentioned, a lot of our engagements, we just come in, support the accounting team in place, and do the monthly close because the other team members are handling their, quote unquote, day jobs within the accounting department. So there are outsourced providers that can do it. The other way I would say is get buy-in from your team. See if there are any time periods throughout the month that they do have capacity, and maybe things can be moved around. Some of these month-end procedures that we were talking about, maybe folks have some time in the middle of a month or at the end of a month, and think about shifting some of these procedures to time periods during the month when they do have capacity. That way, once the month closes and you're actually working on kind of your traditional month-end close, some of these procedures have already been started and hopefully further along their way to be completed, so you don't have quite as much of a heavy lift at the first week or two of the month.
Wow, great ideas. And that kind of leads, I think, into this next question we had come in, which is sort of around the same thing. So this person's saying we're constantly waiting on other departments and they're holding us back. How can we speed up these departments outside of ours?
Yeah, so I think that that comes from management, really kind of that tone at the top. And if waiting on other departments is a big pain point, then we have to set a timeline that management lays out and all of the departments are bought into it, right? So like I mentioned, tone at the top, and all of the department leaders get together and talk about how we can achieve whatever deadline management needs, right? Okay, maybe there's a board meeting on the 20th of the month, so we need our financial statements by the 17th of the month. Well, let's have a meeting with all the leaders in there, okay? And I'm on the finance side, like I'm kind of leading the meeting to make sure that we can accomplish this, but having everybody involved so there is a little bit of transparency and making sure that everybody has ownership of their department's responsibilities and know that, you know, this is coming from management to accomplish a deadline that we all agreed to. We might not like that we have to get the close done by the 10th or the 15th, but management or ownership or the board that we report to wants it done by then. And we agreed that in order to do that, I need this from you by the 7th of the month. So, you know, having that buy-in, having that ownership from everybody, and then making sure they're accountable to whatever leaders or leadership group is setting that timeline. Typically can help. And
yeah, that makes a lot of sense.
Application programming interface. Thank you.
Yes, there you go.
I think I was 1 for 3 on the words, maybe.
So I've got just 2 more quick questions for you, and then we're going to wrap. Next question we had from the audience, Jake, I'm not sure, this one's a little bit more ERP specific, so if this is your question, we might follow up with you offline. So this person says, do you have any other resources about APIs specifically interested in importing bank and credit card records for stage 100? So I think that one might be an offline question.
Yeah, we have stage 100 experience, so it could potentially help if that's a software that you're in and there are some needs there. It could definitely help, but probably more of an offline answer.
Yes, between your team at SWK and Jake, we will definitely get you a response for that. Okay, so my final question before we wrap, again, thanks everyone sticking with us for extra time, is this audience member asked, is using estimates accepted by the IRS?
No, I do not think so. So full disclosure, I'm not a tax CPA, audit, and now kind of on the advisory consulting side. But typically, if you're on cash basis, there's no estimate that's relevant, right? Because everything is as cash comes in or as cash goes out. Most of the clients that we handle on accrual basis, when we deliver their financials to our tax department that might be handling the tax work, they convert it over into cash basis of accounting. If you're a larger company, the IRS does require you to be on accrual basis for the tax work. So I believe if you're on accrual basis, there are some estimates, but they do true that up after the period to make sure those cash payments went out. I think they will true up some of those estimates to what the actual was. So, I would not say change how you do your internal financial reporting, like let your tax CPA fix that on the tax side. And if you're accrual and they convert you to cash for your tax filing, or if you're accrual and they file your taxes on accrual basis, they'll probably do some of those true ups and checks on the back end as they're filing.
Some great to know. So with that, we just want to say thank you. Jake, thank you so much for sharing so much great information with us today. I know we went a little long, everyone, but we wanted to make sure you really got all of those details on accelerating your month-end close. So if you didn't have a chance to answer the poll, or you're seeing this in the recording later and you want to connect with Jake or connect with the team at Whitley Penn to ask some of those questions, find out about some of their services, and really work on accelerating your month-end close, you can always reach out to us at info@swktech.com, and we're happy to connect you. Jake's information was on one of those earlier slides, so we'd love to get you that help and get you guys connected in any way. Any final words, Jake, before we wrap?
No, thank you all for the opportunity to hopefully share some valuable insights. It was nice to speak with everybody. Y'all go enjoy the rest of your spring.
Awesome. Yes, everyone. Hopefully you're having beautiful spring weather. And if not, hopefully it comes to you soon. So enjoy the day. Thank you for joining us, and have a wonderful evening. Bye-bye, everyone.